if you humour me for a second, before we dive into the kind of headline question, I'm going to set the scene shortly. So while the term ESG first emerged around 20 years ago, it became, quote unquote, wildly fashionable within the investment and business community 5 years ago. During that time, ESG investing captured the spotlight, attracting significant inflows. However, the journey has not been without its turbulence. We've seen ESG subjected to growing scrutiny, accusations of greenwashing, performance comparisons, regulatory arbitrage, terminology debates, and politics have put the concept under the microscope. In the last year alone, there's been a slew of headlines forecasting the demise of ESG and sustainable investing. And for the skeptics, there's a lot of talk about kind of spare the win-win, alongside a rally of opinion pieces on how ESG came to mean everything and nothing. So hopefully we're going to unpack some of that in the next half an hour or so. And with this backdrop in mind, we're going to kick off our panel discussion with the title question, Have we passed peak sustainable? So Jeremy, let's start with you.
Great. So I'm Jeremy Taylor. I'm the CEO of Lazard Asset Management. My background is actually as an analyst. So having been at Lazard for 20 years, I spent 15 years as an investment analyst. Coming to the question, have we passed peak sustainable? Absolutely not. What's happening here is we are moving from what I might describe sustainability 1.0 to sustainability 2.0. The beginning point was really investors rushing towards reducing carbon emissions, working out how to measure carbon emissions. And you saw a slew of products arrive onto the marketplace, which were ultimately passive products with a reduction in carbon emissions phased over a period of time. You saw single theme strategies, which really just gave you exposure to the energy transition, not good investments around the energy transition. 2.0 is much more about engagement, and it's about ensuring that the companies that we're invested in are managing their operations correctly and are exposed, positively exposed. Their returns on capital are positively exposed to these themes of sustainability. And, you know, I can speak very confidently from a recent flow perspective because we've seen, I look across Europe, we've seen some very, very large multi-decade investors put billions of dollars to work during this year and which will be implemented next year around exactly this topic. So I'd love to get into this during the discussion.
Great. Andy, are you next?
No is the answer, obviously. We're nowhere near peak sustainability to our mind. I sort of, almost like 2.0, I sort of see us in the foothills of sustainable investing. We possibly have seen peak greenwashing. I'm hoping that is the case. But it's a very different situation we're into now. And the reason we are so confident in that statement is the amount of money that needs to be invested in the world over the next 2-3 decades. I mean, the UN are quoting $4 trillion per annum just to make up the gap between what we think we're spending and what we need to spend to make sustainable differences. So that, and even if they're wrong, those numbers are very big indeed. So our perspective is there's a lot of new money that needs to come into the marketplace. I sort of look at the tech boom and think of it in a slightly similar way. That the next 20 years, the bright people leaving the bright colleges across the US may well go to Silicon Valley, but they may be solving different problems. Rather than worrying about the phone, they may be looking at batteries or satellite or clean energy or new materials. So that's the exciting stuff that I think is going to change, and I don't think we've got to that point now. And the only other thing I'd say is, over the last few years, we've seen, greenwashing aside, an awful lot of new products coming to market that are purely sustainable, whether it's bonds, equities, infrastructure, private or public. So there's a real, I'm not going to say a wall of money because that's just, it's too glib, but this is a developing position. And if you take away the narrative of anti-ESG, anti-sustainable, it's all over, and look at the actual facts, we feel fairly confident that the answer is no.
Great, thank you. Richard, makes sense to come to you next.
Yeah, agree, absolutely no, and very much concur with the first two comments, which I think really characterise very well really the challenge of meeting the global sustainable objectives. And in particular, from our perspective at Victory Hill, we invest in enabling the energy transition to net zero, and as Andy mentioned, you require at least a further $4 trillion a year up to 2030 to be able to keep on track to achieving those objectives. Now, I think what we've seen in 1.0 perhaps is a lot of institutional capital go into the more, I would say, a conventional view of what the transition meant, which is really go into the heavily subsidized renewable utility scale renewable projects, particularly in developed markets. I don't think you're going to be able to achieve a global energy transition just by purely focusing in that way. And as a cohort, we sought to put together a product that addressed it in a more holistic way, meaning addressing the transition in a global context, really. And I think that needs to continue in 2.0. There needs to be directional capital going into other geographies to support the transition, number one. And number two, really, the biggest task that we feel we have, and actually the opportunity set, is there is a lot of institutional capital that is either going into proving technologies on the very early stage, or indeed into infrastructure, heavily de-risked, large-scale infrastructure. But the idea of having proven technologies that need scale-up capital, that's really the opportunity set in 2.0, and that's really where we think there's going to be a lot more inflows, hopefully, certainly in the next phase.
Great. And Leon?
Well, we've heard 3 no's, right? I think the audience wants a different answer. But I can't go all the way to yes, so I'm going to stick with maybe and principally no. So the reason I say maybe, because sustainability means, and sustainable investment means a lot of different things to a lot of different people. I think for sure there's going to be increased investment in things which are going to allow our economy to last or endure in the future, i.e. be sustainable, and investing in the transition has to happen and will happen. So for sure that's going to increase. I think we're going to continue to integrate some of these factors in our investment decision making. We're getting better at it. That will continue. The stewardship on these issues will continue abound. Sadly, I predict that regulation of this will continue. I'm not sure that's a good thing. I think it needs to be revisited. So why do I say maybe? I think when we talk about sustainable funds in secondary markets, when we talk about thematic funds, where you might be investing in low carbon or in biodiversity or in something else which more reflects the values of those investing than value, that's going to be cyclical. And we've seen it to be cyclical. I was on a panel 3 years ago where they were saying it pays to invest ESG. I said, well, it does at the moment because everyone's ignoring it. But once they don't ignore it, as they didn't 3 years ago, there's going to be a bubble, and there was. So investing in so-called ESG funds, thematic funds, is going to be cyclical. So that's why I said maybe.
Okay, fantastic. Well, I know a few points there. You mentioned developed markets, but also money flowing into other geographies. Jeremy is an active investment manager and one that has a very strong emerging markets franchise. If we take a step back, how does the conversation we're having here land when we consider sustainability and the energy transition in emerging markets?
I mean, it only takes a very short visit. I was in India a few weeks ago. We've got a very strong franchise in emerging markets. We, as a firm, do 4,500 company meetings a year. A large proportion of those are actually in emerging markets. India has a long way to go. I mean, it's fantastic to see electric buses driving around Delhi, but as soon as you get up to Jaipur and Udaipur, there isn't a consideration around climate in the way that we have here. We have to be really open about that, and we have to really understand it. The hierarchy of needs, within these huge populations that are developing very quickly, the climate challenge comes much lower down in their priorities. And so, it's very important that, developed economies focus very strongly and increase regulations around emissions. But it's also important that we don't drive production into markets where it isn't as high a priority. So, this is a global challenge. It's a global problem. We have a global climate, and we need to think about it like that. So, it's very complex, and I don't expect investors, or even asset owners to necessarily think through all the nuances of driving capital into one area against another. But as investors and as responsible people, we need to think clearly that we need to bring the emerging markets with us. We did a study actually about 2 years ago, and it was really in response to a question from one of our clients about the use of their carbon budget. This comes back to the first point I made about Scope 1 and Scope 2 carbon being very important. And we explained to them that they should spend the majority of their carbon budget within emerging markets. Because where emerging markets are in their development cycle is going to be more carbon intensive. So you shouldn't measure your developed market portfolio and your emerging market portfolio in the same way. You need to shift your carbon budget to emerging markets. And I think that's, hopefully people recognise, the global aspect of this, the complexity, and not measure it with a single measure.
I think that's certainly a theme that we'll come back to. Andy, we've already kind of mentioned sustainable development requires a vast amount of funding per annum, of which there is currently a shortfall. And you obviously, moving on to kind of the fixed income side, you have a global impact bond fund, you have a global select government bond fund. How does ESG investing translate to fixed income instruments and kind of what's happening in that market today?
I think it's just one of those opportunities that comes along where the governments need to raise debt. There's a private sector that wants to actually use that debt or buy that debt. And we're seeing the development of new markets. So the bonds are important. I think that's going to become a huge market, become a more liquid market. It's something that's, if you talk about sustainable and ESG, you often talk about equities, infrastructure, private, but you haven't so much talked about bonds. Yeah. So we're seeing that. I think it's the early start. It's back to that foothills. Mm-hmm. It's interesting where you see the green shoots coming, and that's why I'm so confident in that future development. You can do a lot of work on the bonds to work out, where that impact's having. Because I think that's the other thing. You can find the impacts easier. It's interesting in emerging markets. We don't invest in emerging markets not because we have anything against it, but it's difficult for us to get that transparency of data and transparency of what's behind. Because our process is fairly deep that way. So, but with the bonds we can do that. So it's an interesting area for us, and we're building out the fixed income franchise. And I'd say that's growing twice as fast as the equity franchise at the moment into the sustainable space.
Okay, Leon, we're actually going to come to you next.
Okay.
EOS at Federated Hermes, I should say, recently celebrated its 20th anniversary. Congratulations, and surpassed 2 trillion in assets under advisement, serving over 70 institutional clients. Obviously, in the realm that you sit in, which is stewardship, through that lens, what impact has stewardship had on sustainability?
The act of stewardship really is about trying to act as an active owner of what you buy. And in our case, in the stewardship service, what our clients buy. And you're trying to make that company perform better. That's what you're trying to do. It shouldn't be conflated simply with E, S, and G. However, governance is right at the heart of it. If you get the governance right, and if you can get a board which is really functioning well, then in a sense you've done your work. And I would probably suggest that at the moment governance has become a little bit too box ticky in the way it's working, and maybe also encouraging boards to be too risk averse. And if we are going to invest in the transition, that probably needs to change a bit. But governance is really at the heart of it. In terms of environment and social issues, they manifest very differently in different companies within different sectors. Now, it is really important, and a lot of our clients, the 70 plus clients you mentioned, these areas are hugely important to them. Every time we survey our clients, climate change is right at the top, labour rights really strongly up there, human capital management more broadly, nature increasing in terms of the interest from clients. And the reason they're very interested in it, because these issues, if you don't address them, the companies just will not perform as well as they might. Now, stewardship is not only about companies. If you think about our clients, a lot of our clients, the pension funds, they're widely invested in the economy. So for them, it is important to get the alpha right. It is important, each and every company, how well they're performing. But it's also about the system, the economic system. And so policy engagement becomes quite important, improving the governance standards in a particular economy, trying to make sure that we have a global approach to how you might account for climate. Those things are really important. So stewardship's also about policy engagement.
Richard, last but not least, we've seen a number of pension funds boards asking themselves to what extent, or at least having these conversations, to what extent are we actually impacting real-world CO2 emissions? And part of that answer in continuing to engage with companies in their listed portfolios seems to lie in private markets. And in recent months, there's been a lot of noise and conversation around directing flows of capital to innovation at a venture capital level, and also large-scale infrastructure at a kind of mega funds level, certainly in this country. But what are you seeing in the middle, in the growth capital segment?
Yeah, I mean, that's a very good question. I think right out the box, when we came together as Victory Hill, the purpose that we had was really to acknowledge the fact that in the sustainable energy system of the future, we couldn't depend on large energy companies to drive that transition. We had to depend on a different cohort, actually, of the middle market, because in the system of the future, a lot of the generation of those renewable electrons and the usage would be done on a more distributed scale. That's our view. And actually, a lot of the innovation behind that and a lot of the ability to promote that would come from middle market management teams. And that's really where you need to focus. And I think what we've seen in 1.0, let's just say, was a lot of large-scale capital dedicated and shifted towards large grid-scale projects that were championed by, let's just say, big renewables. We've moved away from big energy or big oil and gas to big renewables. And I think what's needed right now is an acknowledgement that we need to foster the middle market. There are lots of opportunities that we originate, actually, and we converse with globally in different energy markets, because our central thesis is that the energy transition, as it gets internalized by different liberalized energy markets throughout the world, creates some form of dislocation in that market. And if you're able to invest to solve it through backing these types of middle market development teams, then you will get an impact made, and also, more importantly for investors as well, a differentiated return. And that's where I believe it differs somewhat to investing in grid scale, subsidy-based type of programs that we saw in 1.0. So I think the opportunity set is there. It's large. It just requires a bit more focus from a lot of managers, but it also offers us an opportunity set that we're busy following up.
Interesting. Our next question is a topic we spend a lot of time talking about, thinking about: regulation. Is regulatory pressure accelerating or hindering efforts to invest in the context of climate change? Andy, perhaps we could start with you there for your top-line thoughts.
Delighted. Regulatory change, well, to me this is a trust question, actually. So I've got a couple of views on this. One is it's helpful to send a signal to the industry about, and I'm talking more about the UK here, about what is expected in this space. What's key for any investor, I think, is consistency. So globally, if there's regulation, if it's consistent, that helps a lot. I suspect we stumbled, if we talk about SDR in the UK, we stumbled into that because of lack of trust. The FCA's own research showed that 7 out of 10 investors actually didn't believe that their fund was sustainable, even though it may have said it on the label. So there's a reason for this. And as an industry, have we done all we can to be that robust and move away from greenwashing? So I think there's a point there where that's good. It's hard, but it creates a new... There is a flip side, which is green hushing, which is becoming very real now, where people are now fearful about getting into these markets. Yeah. So we do see lots of asset management groups stepping back from labelling in the SDR space in the UK, which is not great, because I think it's better to have a bigger capital flow. So there's a question there to look at. I think there's the red tape, the work, and that for smaller firms such as ourselves, because we're a lot smaller than my colleagues here, that takes a commitment, and not everyone can do that commitment. We are lucky we can, but that also puts a different competitive lens on the whole thing. So I think even the narrative is difficult. The FTSE 100 companies used to be very upbeat about their ESG packaging, and the result, you know better. The results, they were the front. Now they're not the front. They're often, I'm not going to say buried, they're absolutely there, but they're not leading with it. So I think what we have is a balance between green hushing, because people are scared of the backlash, and the fact that actually a bit of regulation helps. But I'm not a huge fan of regulation per se, but in this space you can see where the sort of taxonomy is important, because we've talked about ESG, I think Leon mentioned it. ESG is not sustainable investing. It's two separate things. So I think there's a place for it.
Okay. Leon, I think we're going to come to you next.
So there's some regulation which I really, really like, and those are the ones which allow us or a company to tell their story. So examples of that, I would say, is the FRC Stewardship Code. There's some principles, and we're able to say what we're doing relative to those principles, and then it's for our clients to hold us to account on whether we're doing that or not. Another one would be TCFD, which has been completely subsumed into ISSB, excuse the four-letter acronyms, which allows one to tell one's story in terms of climate. Again, under a number of different principles. The ones which are prescriptive and encourage disclosure for disclosure's sake, they are problems. And the ones which are pushing, at least on the fund side, to labelling, I think that's an issue. I'm concerned about CSRD, which is encouraging, quite happy for companies to talk about what's material to them, but how are companies going to decide on their own what might be impactful on the environment and society? Don't get me wrong, those things are really important, but how is that really going to manifest? And I think in Europe we've got a real risk here, that we're doing regulation for regulation's sake, and we're going to end up measuring what's not being done. And what we really need to be done is investing in the transition. We need regulation to push us towards real world outcomes and changing things. Yesterday I was at a group, there was probably 30 or 40 investment managers there. I probably can't say where I was, I'm not sure if I'm allowed to, but we had a CFO of a major German company who really wanted to do integrated business. They really believed in sustainability and how it was impacting their business. But they felt that some of the requirements from another four-letter acronym, ESRS, which is more on the environment and social side, weren't really helping them do that. We've got to get that right.
Yeah. Richard.
No, look, I mean, as a practitioner in the context of investing in private markets and driving the transition, we obviously subscribe to a lot of these reporting standards, and I think from our perspective, it is, as Leon said, we want to drive real-world outcomes to support the transition. And to what extent are some of these, reporting regulations more prescriptive than anything else? Within the context of Europe, you can see that it is reflective of the developed world, context for the transition, as opposed to the wider context for it. So it should lead. It should not be too prescriptive. Yeah.
Jeremy, any final thoughts?
I was going to say, I think my panellists have done a good job in unpicking the alphabet soup around regulation. The main point I would leave you with is regulation shouldn't drive the investment decision. And there's been a fear through this process, being an asset manager, that ratings from the third-party providers ultimately create the list of companies that you should invest in, and that will drive us in the wrong direction if that's the case. We need to make sure that we're making the right investment decisions, and they're reflected in the title of the fund or the product that we're providing.
Well, speaking of alphabet soup, and we spoke a lot about it, it was interesting. I was reading it was titled the ESG Special Reports from a well-known investment trade publication. And they started it in 2018, I think. And within the introduction to this piece, they kind of said, look, for simplicity's sake, we're still using ESG, but we recognise that that's, in the process of being phased out. But it was interesting that they addressed that in this kind of conversation more broadly around should ESG as a concept or naming be retired. And some of the research that you've seen today, actually, we asked a question around kind of the backlash and the ESG movement and sentiment. And 54% of global investors agreed that the term ESG will not be widely used in 3 years' time. Would anyone like to start with that? Agree, disagree?
I mean, I looked at the survey and I thought it was very interesting. But part of the survey also referred to the fact that I think there's 71% of investors, would change the way they were investing based on, views
anti-ESG
on anti-ESG sentiment. I'm very happy actually that Lazard is in that 30% that won't change the way they're investing, because these how can I call it, these fashions around acronyms come and go. But what's always critically important, which I think I've said a few times, is really ensuring that we're putting clients' capital to work where they can generate good returns. And we recognise a very significant shift. Let's take the energy transition, and boil it down, around the energy transition. But ultimately, we should try and position our clients' capital where they're going to generate the best returns. I'm going to refer to a study that we've done, again, over the last 20 years, levelised cost of energy study. In 2018 was the point at which renewable energy became cost competitive at scale, wind and solar, against fossil fuels. And that's fully costed. What does that mean? It means that it doesn't matter what policies change, government policies change, this has started and it will now continue. It is cheaper to use electricity, renewable electricity, as your energy source than fossil fuels. Now that transition will take a long period of time, and it requires a lot of capital, and we've talked about that. But as an active manager in this process, we should position our clients' capital where they generate the best return within that, be it battery storage, be it building monitoring, be it electric motors. But it's really important that regulations or the fashions don't drive the investment decision, and the investors maintain their integrity and maintain the way they are investing their clients' capital.
I'm just on the ESG question, the concept be retired. I don't think it should be, but it is. What is it? And so I always feel like it came out of governance as the first step. That's where it came from, and became a sort of. I'm not going to. Again, it's a sort of fiduciary responsibility for companies to be involved in the governance and the ESG per se. But that's different to sustainable investing. And I think the confusion, and I talk as an investor, is huge. So you talk about ESG. That's a very broad church. And then we get questions of, well, I've got this ESG index fund and it's tobacco's its biggest holding, because ESG scores highly for tobacco, so the tobacco companies can have that. Now, I'm not saying that's right or wrong, but you can see the confusion when someone's investing sustainably. So I think it's about the sort of the nomenclature. What does it actually mean? And we have to do better as an industry actually in saying this is sustainable, this is responsible, this is ethical. They're all different. How we can expect those acronyms to be understood by anyone outside our sort of universe is almost impossible. So I think no, it shouldn't be retired, but it's become politicised. It isn't something people want to line up behind, but the concept still remains useful.
Yeah, I agree with that. I think it's become a lightning rod, isn't it, for a lot of sentiment and on both sides. But ultimately, it's driving the behavioural shift underneath. In terms of investments, but it will always be within the context of investments and what are you looking for in terms of generating that alpha for your shareholders. And it just so happens that you can do it in a way that actually makes an impact as well, and that's really important. It's become more important to be able to make the impact and get that alpha as well. So that's really the way that we tend to approach the world, and we think there's still a significant road to travel down in terms of mining that area. Well, I shouldn't say mining, but actually commercializing, getting that alpha for investors, and making the impact. Yeah.
Great. Yeah.
Oh, it's 3 letters, isn't it? Place 14 was sustainability. And look, why did ESG come about back in 2006 when the principles of responsible investment came together? The group who pulled it together saw that there were 3 categories of investment drivers which were being more or less ignored. And they were governance factors, which, as I said, I feel is in a completely different world of its own, and then environment and social factors, and they obviously break down. And it was just nicer to put ESG together rather than GES or SGE and that's how it came about. And because it's 3 letters, it just took off. But now, of course, it's a political movement. So I think it might fall away a bit. People will use the 14-letter word a bit more because it means something a little bit more in English. But even sustainability is now being defined for us, rather than just meaning endure or last. So we'll see.
We'll see. Great. Well, that's a great jumping off point to turn to some audience questions, if we have any. I do have some more in case there's silence.
Hi. One for the panel at large, but possibly initially for Richard, given earlier comments on the grid and the mid-market. But I'd love to know, what point does peak sustainable, when we talk about that, particularly when it comes to large-scale infrastructure, find itself stymied by government? For example, I suppose the ceiling represented by needing to overhaul the grid, and to extend the metaphor a bit further, what's the plan for them breaking through that ceiling?
Yeah, look, I mean, I think if you're talking about reforming the grid, at a large scale, that requires a significant amount of policy support behind it. I think the starting point, really, from our perspective in targeting the middle market is the fact that really the way that energy is produced and consumed, we believe, is changing, fundamentally. And the idea that you have large, power plants generating electrons and distributing that out to millions of users has changed to millions of generators being co-located to where demand centers are. And in a way, actually, I think that obviates the need to reforming the overall grid if you were to go down the distributed route. And we see a lot of this evidence of this occurring not only within the context of Western Europe, perhaps, but also in other areas such as, for example, South Africa, where, by virtue of the fact that there has been historically insufficient source of natural gas as a fuel source for their generators, etc., they've had to look at distributed renewable projects where you have these solar parks next to industrial concerns, etc. So it offers an alternative and even a supplement to the large scale grid scale subsidy based type of projects we have out there. And I think what we offer investors really is a complement to the more de-risk proposition of investing in these large grid scale subsidy-based projects, where they can actually also earn an alpha by targeting middle market scalable opportunities that are private, have private commercialization contracts behind them, which is what we're particularly interested in. And I don't think in the past that's been the case, that much of this has been propagated. All the attention has been on the grid scale. And really my view is there needs to be much more focus now on this other emergent area to complement the grid scale.
Great. I think there's a question right at the back.
Thank you. I'd like to ask the panel their views. Obviously, most of the conversation so far has been on the environmental and the governance side, with a focus really more on the social side. The question is this: given the dominance in the markets, particularly at the moment with the Magnificent Seven, I'd like to ask the panel's view on their social responsibility, or in some cases, lack of social responsibility of those firms, and how, as an investor, one can handle that. And I think, particularly with reference to two aspects. Firstly, the rise in mental health problems and teenage suicide in particular, part of which I think is a direct consequence of the behaviour of some of these firms. And secondly, the moves that some of these firms have done, or some of them not done, to undermine democracy in many key countries, including the UK.
Well, from an EdenTree perspective, most of the Magnificent Seven we don't hold, and some of the reasons are what you've just said, because we do a lot of work on the social side. It's not just about the P&L. And of course, that's an interesting dichotomy, because from a performance perspective, if you're running a global fund, as one of our fund managers is, you lag the benchmark and then people leave. But the debate is more important than that. And I think absolutely the sort of workers' rights, labour rights, is a huge part of the selection process in a sustainable fund company, and gets lost when you talk about the tick boxing and the ESG scores, going back to that. So to that question, it actually should be the heart of a sustainable investment policy, not as an add-on. Of course, you balance that up with does it make any money? But if you're outside the Mag 7, you've not done as well as you would have liked to have done. And I think that's one of the reasons why we're having this conversation about have we past peaks sustainable, is because people have disconnected what is a very real issue with I've made a load of money. And so we've got that sort of balancing out of, do you want to make money or do you want to be a good citizen, and can you balance the two together? So I think it's a fantastic question.
And from a stewardship point of view, so some of our clients do hold the Magnificent Seven, and so they are in our engagement program. And we do engage them on data privacy, on the impact they might be having on teenagers' mental health through the social networks which exist. They're definitely part of our engagement. Are we successful? How successful are we? Well, and let's be honest, we only have so much influence over these major companies who have significant power within the founders. However, the influence one can have is this will impact their business. Fundamentally, it's got to impact the business because unless they get on top of some of those issues, they are going to either be regulated or going to lose that business. So there is hope there. On mental health is an issue which cuts across all companies. And when we engage on mental health, and it is something we're doing as part of what we do on what's called human capital management. It's not only about how does a company respond when there is an issue. It's also about what do they put in place, what's the structures in place, what are the policies in place to try and manage mental health and allow it to be addressed. And so that's a growing part of what we're doing from a stewardship point of view. Very difficult area, but one which there could be huge, this is obviously really important for its own sake, but there can be huge productivity improvements as a result.
I think the essence of your question is way beyond investing. We are going through. Well, start with technology is accelerating, and the use of technology by the next generation is completely different than the way that we used it, and that's going to require the companies themselves to be very sensitive to the way that they encourage the use of their systems, and it's going to require society actually to push back on some of the tools that get put in front of our children, and I think it's ultimately going to require more regulation around these companies, but really the companies need to help solve this problem themselves. So I think a very, very important question, but I think beyond just the scope of this panel.
Great. Well, I think that actually brings us to the end of our panel. I know we've kind of barely scratched the surface on everything that could encompass ESG and sustainable investing, but it's been fascinating. So thank you so much for our panelists. We could give them a round of applause.